Peru is, without exaggeration, a rare case in Latin America. Yes, its politics are a complete circus, 8 presidents in 10 years, and if we keep up the pace, the 9th must already be warming up on the sidelines. But, against all odds, Peru has been the fastest growing country in the region in recent decades. The key to this miracle? Spoiler alert, it's not the political class. The star here is the central bank. Independent, protected by the constitution, and with a reputation that many developed countries would love to have. Thanks to this bank, the Peruvian sol is one of the most stable currencies on the planet. Inflation, barely 1.5% year on year. And the forecast for the next 12 months is around 2.5%. In a region accustomed to ups and downs, this is almost science fiction. And not surprisingly, that leaves us with headlines like this.
Peru's central bank buys $27 million to curb the appreciation of the sol. The amount is not that significant, but it has a psychological impact. The central bank is signaling its concern about the speed at which the sol is appreciating.
Because, listen up, the sol has appreciated 11% this year. It's at its highest level since 2020. It's the strongest currency in all of Latin America, and the 3rd most highly regarded worldwide. So much so that the central bank has had to step in to calm the waters, not to slow down the rise, but to send a clear message to the market. Take note, we're watching. And with good reason. The Peruvian model has been so successful that even Argentina has taken inspiration from it to reform its own monetary system. But while the Argentine peso continues to fall against the dollar, the Peruvian sol is skyrocketing. So, now that you know that, here comes the interesting part. Why is the Peruvian sol booming? What impact could this have on its economy? And what do Donald Trump, China, and Bolivia have to do with all this? So how is it possible that, in a region known for monetary chaos, one country manages to keep inflation under control and its currency among the strongest in the world? Because, here's the uncomfortable truth, most economic miracles are not miracles. They are a result of institutions that understand money, how it moves, how it's protected, and how markets react. And this is precisely why what's happening in Peru matters far beyond Lima. Because whether you live in Latin America, Europe, or the United States, you are also exposed to inflation, currency swings, central bank decisions, and political noise. The difference is that some people understand what's going on, and others are simply at the mercy of it. That's exactly why we created the Visual Factory Club. If you're interested in the world of investing, if you want to learn how to manage your savings, protect yourself against inflation, and figure out how to make money beyond your day job, this is for you. At Visual Factory Club, every week we send out a free newsletter focused on essential financial education, the ABC of what everyone should know to understand the stock market, financial markets in general, investment platforms, how to assess opportunities, and which markets may have more or less potential. Because if you don't understand the basics of finance, you're not managing your money, you're just reacting to it. When you sign up, you'll also receive a clear and simple dossier explaining key investment concepts, what multiples or the PE ratio are, what indices, ETFs, derivatives, funds, and EPS means, all without jargon. After that, every week you'll receive additional materials and market analysis to help you stay informed about what's really going on in the global economy. And since each edition is unique and sent by email, if you're not subscribed, you might miss some of them, and you won't be able to access them later. So click the link below or scan the QR code on the screen to sign up for the club and start receiving the upcoming editions. And now, let's break down what's really happening in Peru. On Visualeconomik, we've already talked a few times about how Peru achieved the most stable currency in Latin America. There's no mystery to it. On the one hand, we're talking about one of the few Latin American countries with a truly independent central bank. Because yes, many institutions in these countries are modelled after the US, but only on paper, not in Peru. There, the BCRP does not lend money to the government to finance any election campaigns, nor does it allow politicians to pressure it to appreciate or devalue the sol as they see fit. Instead, its management team has free rein to operate as they see fit. Operate what, exactly? Well, it's very simple. Normally, countries have one of two possible monetary systems. Either they peg the value of their currency to another, such as the dollar, or they let the value of their currency float freely on the market like any other commodity. However, Peru has a system somewhere in the middle, dirty floating. The Peruvian sol floats freely on the market, but not entirely. When the central bank feels that it's rising too high or falling too low, it intervenes. It buys or sells dollars. It's that simple. And that's exactly what has been happening in recent days. Take a look at this graph. Here, you can see the evolution of the exchange rate. And I don't need to tell you when Peru changed the rules of the game, right? The turnaround was radical. In a matter of years, they went from having one of the most volatile currencies in the region to being the example of stability that many neighbors want to copy. But now the headlines are no longer about how stable the sol is, they're about how much it's appreciating. And while that sounds positive, it's not necessarily good news. Just ask the Swiss, who've been fighting for a decade to weaken the franc and haven't succeeded. So what's going on? Well, this time, we don't have to look for culprits in Lima. The key is much further afield, and has a name: Donald Trump. Since Trump returned to the White House, the dollar has lost more than 10% of its value. The reason? His new tariff war. Now, if you've read any basic economics textbook, you're probably thinking, wait, tariffs mean fewer imports, right? And if you buy less from abroad, there's less demand for foreign currency, and your currency appreciates. True, but with the dollar, it's not that simple. Because the dollar is not just any currency. It's the heart of the global financial system. And it is so for one reason. It can be issued like crazy and still maintain its value. That's its magic. Stability and predictability. But obviously, if a president suddenly appears who threatens to break the rules of the game, that confidence falters, and then the dollar loses its main appeal. Yes, I know we're talking about the Peruvian sol, not the dollar, but remember the basics. When one currency falls, it's because others rise. Does that mean the sol's boom is entirely Trump's fault? The short answer is no. If that were the only reason, we would all see the world's currencies skyrocket. And that is not the case. The sol has not only gained ground against the dollar, it has also strengthened against the euro, which has fallen 3% against the sol so far this year. So, the long answer. The blow to the dollar has had an impact, but a more indirect one than it seems. Because when the dollar falters, other assets come to the fore. And in this case, one shines above the rest. Gold. And that, visual economic community, has a lot to do with what is happening in Peru.
About 9% of that appreciation is due to the improvement in Peru's terms of trade, thanks to the increased value of its gold exports. Gold accounts for 36% of Peru's exports, and the precious metals rally has caused Peru's terms of trade to improve by 22% year-to-date, the bank said.
The value of the sol, like that of any other currency, depends on the assets that its issuer has to back it up. In Peru's case, those assets are the dollars it earns from exporting raw materials, one of its main economic activities. So when raw materials go up, Peru rubs its hands together, because that means tons of dollars coming into the country. Add to that the fact that the price of oil, one of Peru's main imports, is so low, well, mystery solved. But remember, this is nothing new. In the early years of this century, we also experienced a real boom in raw materials. And as is happening now, the Central Bank of Peru began to accumulate reserves on a large scale. The result? The sol skyrocketed. It went from 3.3 to 2.5 sols per dollar, an exchange rate even stronger than the current one. Yet, not everything is rosy. Because if anything defines the commodities market, it's its roller coaster trend. One minute you're at the top, the next you're crashing down without warning. In fact, copper, one of the crown jewels of Peruvian exports, has already fallen more than 4% in recent weeks. That is no small thing. This is where the dirty float system comes into play. What is that? Basically, it's a system to prevent market fluctuations from wrecking the economy. If the exchange rate were fixed, every time copper or gold prices fell, the central bank would have to cover the trade deficit by burning through reserves, and that's not sustainable. With a floating rate, the opposite happens. Reserves are maintained, but the currency appreciates too much, and that makes exporting increasingly difficult. The problem: if exporting companies stop investing because it's no longer profitable for them, damage is not temporary, it can be permanent. A dirty float attempts to find a middle ground. The sol shouldn't rise so high as to sink exports, but without emptying the central bank's coffers either. Of course, for all this to work, Peru needs to have a real safety net. We're talking about $75 billion in reserves. That is 30% of its GDP. To give you an idea, that's almost double what Argentina's central bank has, even though Argentina's economy is 2.5 times larger. And here's the thing. When the dollar falls, other currencies tend to rise, but the Peruvian sol rises more because it's backed by gold. And of course, gold also rises when the dollar falls. Confusing? Well, wait, there's one more twist. Because of all this, the dollar, gold, the sol, has one side effect that very few are seeing: hybrid derivatives. And yes, it sounds technical, but trust me, it gets even more interesting.
Because of Peru's direct link to gold, we've seen growing interest from clients wanting to position themselves. For instance, clients have been buying Peruvian bonds without hedging the FX risk related to those bonds in order to take advantage of the stronger sol environment.
So-called hybrid derivatives related to gold have skyrocketed. In just 1 year, they've more than doubled. And among the big winners in this gold rush is, of course, Peru. Now then, what on earth are these derivatives? Without getting into technicalities, think of it this way. There are investors who want to jump on the gold bandwagon, but without buying gold directly. The alternative, bet on currencies from countries that export gold, such as the Peruvian sol. They are complex instruments, full of formulas, options, and leverage. But what you need to know is this. They increase the demand for sols. And you know what happens when something becomes fashionable in the markets? The price goes up. More demand means more value for the sol. Now, if we're talking about more demand for Peruvian sols, there's another issue we need to discuss, and a crucial one.
Crisis in Bolivia. Peruvian currency used as a refuge in the highland country. One sol is exchanged for approximately 3 bolivianos, a rate much higher than the official rate, which has generated informal commercial opportunities.
The fact that Bolivia is not going through its best moment is not something that comes as a surprise to anyone. The Andean nation is experiencing a real economic, social, and political crisis. What you may not know is that on the border with Peru, sols have become a real treasure. Sometimes they're the only way to escape the local currency. And it's not that people have started shopping with Peruvian sols. In reality, what is happening is that these sols are the best way to get dollars due to all the financial controls and artificial exchange rates imposed by the government. Check it out. During the pandemic, many people considered Bolivia to be a role model. While inflation exceeded 10% in many developed countries, in Bolivia it barely grew from 2 to 3%. A real success. Of course, there was a catch, and a very simple one at that. The reason inflation was not rising in Bolivia was because the government was blowing through its dollar reserves to subsidize prices and keep them artificially low. But naturally, reserves are not infinite. In 2014, Bolivia was riding the wave of natural gas and maintained net reserves of $15 billion. These days, there are barely $120 million left in liquid reserves. That's about half of Cristiano Ronaldo's salary. When the reserves ran out, inflation in Bolivia skyrocketed, faster and higher than in any neighboring country. The Boliviano lost more than 50% of its value, and in supermarkets, food began to disappear. Given this situation, it's easy to understand why no one in Bolivia wants to have Bolivianos in their wallet. The logical solution? Dollars. But of course, getting them is not exactly easy. The official market is full of obstacles, and the black market is extremely expensive. However, there is an alternative route. The market between Peruvian sols and dollars is much more fluid, without so many obstacles or extra costs. The result, right now, it's cheaper to exchange Bolivianos for sols, and then those sols for dollars, than to buy dollars directly from Bolivia. And take note, because this isn't only happening in Bolivia. A similar pattern is beginning to emerge on the border with Brazil, although the use of sols is much less common there. But as with everything in economics, there are side effects. The Bolivarian crisis has caused a mass exodus. It's estimated that nearly 1 million Bolivians could emigrate to Peru. That's 1 million more people needing sols to live, rent, buy, work. Does this explain part of the sol's appreciation? Well, maybe. But honestly, we don't know. It's a complex phenomenon, and it will take years to have solid studies on the subject. What we do know is that the Central Bank of Peru is increasingly concerned about this issue, and it has already made it clear that it will intervene if things get out of hand. However, the main concern is not that the sol continues to appreciate. An 11% revaluation in less than a year is outrageous, but this rise has two pillars. 1. The crisis of confidence in the dollar, and 2. The economic collapse of Bolivia. And typically, sooner or later, both situations will stabilize. The problem? When that happens, the one who stands to lose is the sol. Of course, the Peruvian central bank has plenty of muscle to act. We've already seen this, and its monetary system is designed precisely to withstand these shocks. Even so, if this whole episode makes anything clear, it's that, in economics, second and third order effects exist, and they're not always foreseeable. That's why, in the end, the hardest part isn't having good tools, it's knowing how to use them well. But now it's your turn. Did you expect Peru to be so dependent on raw materials? Are you surprised that a tariff war in the United States has such a big impact on the Peruvian sol? Will we see a fall in the sol if Bolivia and the US return in normal? We look forward to reading your comments. You can leave your response below. Don't forget that here on Visualeconomik, we release new videos every week, so subscribe if you haven't already to make sure you don't miss any of our upcoming episodes. If you like the video, give it a like, and I'll see you in the next one. Take care. See you next time.